So another question, how do you calculate income? How do I even know if I make enough to bother you? So the first thing that I will say to that is that you are never bothering me. I absolutely love what I do. It's sick, but for some reason this just gives me a quite a bit of joy figuring this stuff out. So they say you really like what you do, you'll never work a day in your life. Like I truly, that's the case with me in the mortgage business. How do we calculate income is it depends, to be honest with you. There are many different ways depending on the loan program that you're selecting that we can calculate your income. If you are a W-2 salaried employee, it's very, very straightforward. We take the amount before taxes. So not your net, but your gross amount. Like let's say you make $100,000 salary. We're going to take $100,000 divided by 12. We're going to subtract any alimony or child support that you make, and that's the income that you're gonna provide. Child support and alimony is treated for mortgage purpose as a reduction in income, not as a debt. So it changes the math with the fraction a little bit. It's very slight difference, but distinction that is made. If you're self-employed or if you're a commission employee, that's when things get a little bit more complicated. I always tell people like don't bother trying to figure out what your income is. That's my job. There's a pretty concise, brief list of documents that I need in either one of these scenarios to calculate what your income is. Both on a conventional sort of traditional income calculation, and then we have all you know, um, these other calculations that look a little bit differently. Like for example, conventional lending, if you're a commission employee, we average 2 years of receipt. So if you make $50,000 the first year, 150,000 the second year because you're getting more successful in your commission job, you got $200,000 over 2 years, which means you're going to get $100,000 a year in credit for income if you're like a variable employee. We also have other loan programs that will look at only the most recent 1 year. We have other loan programs that will only look at your W-2s without taking into account what your year-to-date pay stubs say. We have loan programs that will go based off of the gross receipt into your bank account. So basically whatever your net pay is averaged over a 12-month period. So like let's say you get bonuses, or let's say you get like a stipend or something like that. Like a lot of people I know, I did a loan for a guy who worked for a financial firm, and he had a lot of basically like a lot of expenses where he was doing like dinners and stuff like that, and he had an expense account that was deposited into his bank account. So from a traditional standpoint, we wouldn't be able to count the fact that he made a lower base salary, lower commissions, but he had a $10,000 expense account contribution into his bank account every month. Like we would take the expense account out of the equation traditionally, but on the loan program that we used, we looked at net deposits into his bank account over 12 months. And we took that $10,000, so it added an extra $120,000 a year in income and allowed him to buy the type of house that he wanted to buy, based on the money that he was pulling out of his expense account to pay his bills, every month. So the moral of the story, like the short or long, the long and short of it is, you're never wasting our time. There are more programs available for people with complicated income than you could possibly imagine. Um, and I generally tell people it is more likely than not, if you have complicated income, then we will be able to make something work for you. It may not be at the price point that you want. It may not be at the down payment you want. You know what I mean? Like there are options, and there's give and take with some of this stuff. And even if you have like a lower income, if you're nowhere near the numbers that I'm talking about, if you're making $40,000 a year, $30,000 a year, um, there is still an amount of money that you qualify for on a mortgage. You know what I mean? It may not be enough to purchase the house that you want, um, but at least when we have a conversation with somebody who maybe they're only qualified to buy $150,000 property, and all the houses they like are 250. Once we have that information in our system, and we have kind of an idea of this is where you're at, this is what your debts are, this is what this allows you to purchase, you can buy for 150. well, then we can have a productive conversation with that person and let them know exactly, okay, maybe you're not where you are, maybe you're not where you want to be as far as buying power right now. However, if you get rid of this amount of debt or you make this much more money, this will put you at your 250 price point or whatever the, whatever the case might be, and then you'll know basically exactly where exactly where you stand. And you'll know essentially if you want to buy a house for 250, you currently make $30,000 a year, that once you get to $41,000 a year, and as long as you don't have more debt, you'll be able to buy that house for 250 or whatever the numbers might be. So I always encourage people to seek information about this stuff, because if you don't know, if you never ask, you'll never know. If you ask and it doesn't shake out to exactly what you expect or what you need, that's okay. You know what I mean? We'll give you the information that you need in order to get where you want to be. Um, and we'll leave you with that, and let you make whatever changes you have to make. So my catch all is always reach out if you have questions. You're never wasting anybody's time. We'd be more